This meeting is being recorded.
Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with Taylor from Life Goal Investments. How you doing, buddy?
Doing great, doing great. Thanks so much for having me, as always.
Oh, man, I've been waiting for this conversation because, again, you're my Wall Street guy, 10 years on the street, and I don't understand what's going on. The 10-year note has crashed from 3.49. Last time I checked, sub 2.8. We have yield curve inversion in the 2s and 10s. And we still have the Fed saying rates are going up, up, up. Is it as simple as Wall Street doesn't believe the Fed? Is it Wall Street thinks a nasty, deep, dark recession is coming? How the hell can the 10-year note fall 70 basis points in like 10 business days? What the hell?
Yeah. It's been a violent movement. It's been interesting. Obviously, from the beginning of the year, you've had a violent movement upward in all treasury rates.
Yeah.
And now we've got this massive reversal. And I think it speaks volumes to something that you just said specifically. The 10-year, think of that as intermediate to long duration.
Mm-hmm.
Intermediate to long duration treasuries are going to be priced on kind of a mixture of two things: growth of the economy and inflation in the economy, and a combination thereof. And those two things kind of go hand in hand to begin with, right? So to an extent. But what it does not speak to is the front end of the curve, call it 2-year treasury and in, that is priced off of what the market expects the Fed to do. So essentially, so there's your dichotomy. Right now, what the market's saying is we still think the Fed is going to be relatively aggressive on their rate rise, although they have moderated their thoughts some. We could talk about that.
Yeah.
So we still think the Fed has to curb inflation, and therefore it needs to take rates higher in order to do so. But on the back end of the curve, the 10-year treasury and out further, it's saying growth is slowing, and unequivocally saying growth is slowing.
So really what they're saying is the Fed's going to do its job. The Fed is going to beat back inflation by raising rates. Hence the front end is up, the back end is down. And so they think that, what is it called? The 5-year forward or whatever that's called, kind of where inflation is. Where is that today?
Oh boy. The 5-year forward's at a 2-year low right now.
Shush.
So
no way.
Yes, it is. Yes, it is. The 5-year. Well, and this is as of this morning, so I don't know if it is as of right now. But as of this morning, the 5-year forward was just north of 2%. So
now tell people what the 5-year forward is.
Yeah, what we're saying there is 5 years out from now, the market is projecting inflation to be 2% for a 5-year period of time. It was at like 208. So again, that's saying 5 years from now, when you look at that 5-year period of time. So, okay, let me use numbers because I don't want to confuse this. If you start in 2027 and look to 2032,
perfect.
That 5-year period of time, they expect inflation to run at 2.08%. That was what the number was as of this morning, which is a 2-year low. So what they're saying there is the Fed is going to force us into a recession, and that's going to drive down prices. Why do you ever have an inverted yield curve? Well, we've spoken a little bit about this, Michael. Like if I'm lending you as a friend money, the longer period of time I'm lending you that money, the more I'm going to make you pay me. Exactly. When the yield curve is normal, longer dated debt, me lending the government money for a longer period of time is going to get me a higher coupon. When it inverts like it is now, and shorter dated debt, 2 years are paying you more than 10 years, what the market is saying is the Fed is going to have to cut rates. And the only reason the Fed cuts rates is to spur on the economy, saying that the Fed right now, with the rate hike cycle that we're in, are going to cause a recession.
So the other thing that, again, as a Wall Street guy, you can get me is, I think it was 2 weeks ago when we talked, they were kind of the betting markets had the Fed topping out at 3.4, I think, Fed funds rate. I'm guessing it came in.
Yep. Yeah. So here, let me kind of dig right now as we look at this. So the Fed funds is expected actually. So it's funny. What is the terminal rate? I think the terminal rate's at about 3.25 right now.
Okay.
So terminal rate, meaning the Fed funds rate is going to get to 3.25% before they have to pump the brakes and hit the stop. But what they're also anticipating in the first half of the second year, or of 2023 rather, is a rate cut. So we're going from massively raising rates to subduing them on their side. And Michael, if you remember last week, we had this conversation. I said, listen, this is not the first time we've seen this. In 2018, the Fed raised rates in December, and they cut rates in July of 2019.
Yeah.
So them overdoing things one direction or the other is not something that's new or foreign to the market. And that's the market's pricing in right now, the fact that the Fed is going to have to cut rates.
Yeah. So again, so we have 4 Fed meetings left. We have one, not next week, but the week after, I believe. Are they still, is the market still expect 75, or have they pulled that back to 50?
Oh, so right now, and this is how volatile this market is. This is how volatile the market is right now, and inherently volatile Fed rate hike expectations are. So it's now gone from a foregone conclusion that it was going to be 75 basis point hike at the next meeting to now looking like it'll be 50, and that's about a 90% chance, and 25 basis points, which is obviously significantly lower at a 10% chance. So you're getting a massive repricing, and that's why you're seeing this massive movement in the Treasury market.
Yeah. Well, that's going to be very interesting because I think it's next Friday the CPI comes out. And I think it's the 14th.
You're probably right. Yeah.
Yeah. Or maybe it's Thursday. Anyways, I think CPI is next week, and there's a chance that we haven't seen peak inflation at 8.6.
Yeah, we'll see. It's interesting. I have been on the rolling over of inflation side, admittedly early, but you are seeing, and you're now seeing it hit the news in a big way. What we've been talking about for a little bit of time now are commodity prices are rolling over.
Right, which may impact next month, but I'm not sure it helped last month.
Well, right. And the big one there being energy and oil, right? So energy and oil is just starting to roll over now in a meaningful way. It's been the better part of a month probably now, but to your point, it's a month in the rears. Yeah. So that had been the one that had been stubborn when you look at the broad commodity basket. Mm-hmm. But if you look at all of the input costs that go into things that we produce, et cetera, the big one being copper. Copper's a really good leading indicator. Yeah. Really good leading indicator. So copper has gone into a bear market every one of the last recessions that we've seen. Yeah. So copper's in a bear market right now from their peak to where it's at pricing wise. Lumber, we've talked about because of the housing market and mortgage rate ballooning to the extent that we haven't been able to comprehend almost. The lumber market's in absolute free fall. That's a huge input cost. Yeah. But yeah, you go across nickel, iron, et cetera, across the board, those commodities are rolling over. And that's saying that corporations that are building things, et cetera, are going to be bringing in less input because they think they can sell on the other side less because the consumer's weaker.
So then the other thing I wanted to talk to you about, because again, you've been in the game a long time, is there's a good chance, right? The Atlanta Fed, the Fed indicator, whatever they call it, the forecast.
GDP now, yeah.
Yeah, GDP now, thank you. Is forecasting a negative number for Q2, which after a Q1 negative would, kind of armchair economists mean a recession. As you likely know, that's a rule. It's not a requirement, right? If you go back to 1947 was the last time it happened. It's not a foregone conclusion. And I actually think this Friday's jobs number, if it's positive 200 grand or more, I don't see these economists calling a recession, because how can you have a recession when you had 6 months of job growth? I just don't see it.
It'll be interesting. Yeah. And in 2001, on the other hand, conversely, there was not 2 negative quarters of GDP subsequent to each other, and they did declare a recession. So it goes both ways, where again, the it's not formal, I guess. The commonly accepted definition of a recession are 2 consecutive quarters of negative GDP growth, just economy shrinking for 2 straight quarters. But the technical definition is not a technical real thing. It's more qualitative. So they look at the quantitative data, and then they actually report back whether they think the Bureau of Labor Statistics, one of those big governmental bureaus, determines whether we are or not in a recession at that point. So Michael's point is very fair and valid. We could have contraction of GDP for 2 straight quarters, but with an unemployment rate that's, bottom of the barrel, which is a good thing for the economy, they could say, no, I see it. I see the numbers. They're both negative, but no, we're not going to declare the recession here.
Yeah, there are 4 other inputs, because again, I have an econ degree and we study these things, and I had to go back and look it up. So I think I remember 3 of them. So one is employment. Again, if you have 6 months of 6-figure job growth, I don't see him saying yes. Another one is retail sales. Retail sales has been up and down for 6 months. Real incomes, right? What's going on with incomes? Is it up or down? And then the other one is industrial production. See, look at that. I remembered all 4. industrial
There you
production.
go.
What's going on there? So
I'm impressed. I'm impressed. And so, yeah, so to like your real income, people might be thinking to themselves like, well, incomes are going up. Like you are seeing wage increase, but real means
real,
adjusted for inflation. And
correct.
inflation is going up at a faster pace than wages are. So real wage growth is negative.
Yeah, is negative.
Right.
So again,
And
it's
industrial
gonna,
production is coming down. The numbers from the industry right now are coming down in a big way, and that's
Yeah.
what's scaring the market. That's why you're seeing commodity prices roll over. All of those inputs that big industry utilizes to create whatever it is their widget on the other end are rolling over. So it'll be interesting, Michael. It'll be really interesting if the wage, if jobs and unemployment is low, but you do get that negative 2 quarters of GDP. I tell you what, there will be people out there screaming and shouting if you get
Oh,
two
yeah.
negative quarters and they don't declare a recession.
the government's
It'll be,
faking the numbers, blah, blah, blah.
Yeah. Your economic counterparts, in colleges will be picketing at that point.
Yeah, exactly. It's going to be a lot. And then the last thing to talk about, again, we've already seen multiple compression. I think over the next 30 days, I can't believe Wall Street analysts have earnings up 10% and then 9%. We're about to see some earnings get whacked in the next 3 weeks. What do you think?
Yeah, I can't disagree with you there at all. I've been stating that for a bit of time now. What we see here is the Q3 estimate from the average analyst is still up 10% year over year.
That's nuts.
And the nuts thing about it too, Michael, is like if you go back, because I just did go back and look at the data, Q3 2021 data, so the comparables, so we're at Q3 2022. The Q3 2021 comparables are some of the largest numbers on record. The growth in 2021, which we're now comparing to, are record numbers. So we're building off of that base of a record number, and they're still saying there's going to be 10% growth for the quarter. That's tough, Michael. That's tough to stomach. It really is.
Well, I'm going to guess in the next 3 weeks, it's not so tough to stomach.
Yeah, we'll see. You know what though? I think that the market has priced some of that, but I don't. If it comes in, it could get ugly. What you've seen is, to your point, the price or the price multiple that someone's willing to pay for a dollar worth of earning has come down from 21 to just under 16 as of right now. But you have not seen the earnings movement.
There's another variable. It's called E.
Yes, exactly.
That might go down.
Yep, the denominator is dangerous right now.
Exactly. Well, I always appreciate our conversation. It is a wild time. I appreciate you being our Wall Street guy. Taylor, where can people find you?
Yeah. Look us up at Life Goal Investments on Instagram. We're just putting out daily content like this, short form.
Absolutely.
So hopefully you learn something.
No, check them out. Definitely subscribe. I comment almost several times a week. You put out a lot of great stuff. So thank you for what you do.
You're the man. Thank you.